And what we're going over is we're going over tricky areas, and oftentimes when you go through these and you get into the sandbox, so to speak, the results are quite surprising. And you may just first look at a balance sheet and an income statement and say, hey, this looks like a pretty good investment. And once you really dig deep into, especially into their leases and their pension obligations, you're suddenly going to see that this company has really big problems. And I used to do an example with airlines. I forget what the airline was. I think it was United Airlines. And I showed that if you capitalize all the leases and you book the company's full pension liability, you take the full pension liability and you put it on the books, the company is bankrupt. There's nothing there for stockholders at all. And investors buy and sell this as if nothing's going on. And they don't realize what's really going on. What's really going on is that this company almost has no equity at all. And the level of financial risk involved in this company is absolutely huge. And it's there right in the numbers, and you can see it. Now, this accounting has been changed. As you can see, lease accounting is changing. Pension accounting has been adjusted a little bit, has been reformed, but it's still not completely clear. And so you want to be extremely careful to find out what kind of off-balance sheet financing is out there, and how does it really distort the balance sheet? And you do that in the sandbox. So with pensions, there's two kinds of pensions. There's what's called defined contribution and defined benefit pension. Today, most jobs that you get, it use what's called a defined contribution plan. And this is usually a 401k plan. And the way defined contribution plans work is that you take a percentage of your income and you put it into this fund, and your company may match it and put put additional money into the fund as an incentive. For example, what's very common is that you might contribute 6 or 7% of your income, and then your company contributes 25% of that. So if it's 7%, they contribute, I guess, is 1.75% of your income. The company puts in there, and the government incentive is that when you put money into a 401k, it's deducted from your gross income and it's not taxed yet. Now, when you take the money out of the 401k, including all the income that's accrued, then it's taxable. So a defined contribution plan works like that. And today, most companies only have a defined contribution plan. And it's very rare, if you start a job, it's very rare the employer, at least for private employers, that have defined contribution plans. Defined benefit plans are usually much older companies. Oftentimes, they're only for the older employees who started working there, decades ago, and also for union employees and for government employees. Usually have a defined benefit plan. And the way a defined benefit plan works is that when you retire, you're entitled to a fixed amount of money every year, or a fixed amount of money. In government, the way it usually works is it's a percentage of your income, let's say averaged over the last 2 or 3 years of employment. So what the company needs to do is it needs to put money away every year in order to make sure there's going to be enough money to pay the employees their pensions. And this is governed by the federal government with an act called ERISA, E-R-I-S-A. And so what would happen is the company, sometimes employees also have to make a contribution, but it's somewhat unusual. Usually the company makes all the contributions. They contribute it to a fund, and that fund is expected to accumulate enough money so that when the employees retire, there's going to be enough to pay those employees their benefit. Some defined benefit plans are overfunded, but some are underfunded, especially government plans tend to be underfunded, and especially New Jersey government plans are extremely underfunded. If you live in New Jersey, you could read in the newspaper about problems with New Jersey's retirement plan. Anyway, these investments are usually held by a third party, an investment company, and actuaries are going to continuously analyze the amount of money that's needed and to assure that the plan is sufficiently funded in order to be able to pay the benefits. And there's PGBC, the Pension Guarantee Benefit Corporation, actually guarantees that pension monies are going to be available for employees. So as long as the companies pay the minimum amount of money that the actuaries require them to pay, then the amount that employees receive when they retire will be guaranteed by the government. Putting the money in a separate fund provides employees also with a certain level of security, so that if the company should go bankrupt, the money is this money is in a separate fund. It's not owned by the company per se, but it's its own corporation, and the pension money itself cannot be touched. So if you see an employer, none of the big four are going to give you a defined benefit plan if you're going to work for the big four, and today they're very rare, except with much older legacy companies. Usually they have what they call legacy plans that older employees had who've been working there forever. But if you were to go work for these same companies, they're going to give you a defined contribution plan or 401k. If you go work for the government, either the state of New Jersey or one of the municipalities, chances are that you'll have a defined benefit plan that's governed with a union contract, and therefore you will be entitled to this benefit. Accounting for defined contribution plans is very straightforward. Basically, the company becomes liable to make these contributions as the employees make theirs. They have what they call the match, 25%, let's say. Seton Hall is very nice. You pay 2% of your salary, and Seton Hall matches it with 6% of your salary. So it's really a 3-for-1 match, which is really, you know, it's actually it's a very generous plan. And then the amount of the liability is just whatever the match the company hasn't yet paid. And then once it pays that match, which it usually pays the same time as it pays its payroll, once it pays the match, then there's no liability. And companies really like this because it's clean. Defined benefit plans are very problematic, though, accounting-wise, because the formulas often change, and the estimates and assumptions needed to estimate the liabilities sometimes change. Sometimes companies decide to offer more money, sometimes they offer less, and so the amount of the overall liability for a defined benefit plan may change over time. So companies will set aside cash and invest it, but if the investment return is too low, then they're going to need to pay more money in. And this can cause huge problems. So they need to manage a portfolio of investments exclusively for the retirees. And a major legacy pension for a large corporation may have so much in assets invested that it may actually exceed the size of the company. Before GM went bankrupt, even though GM GM's pension assets actually exceeded the company's assets themselves. The problem was the liabilities were way, way higher than the assets, and that was a big problem for them. But oftentimes legacy pension plans are larger than the companies that contributed to them, because so much investments are necessary in order to fund the pension and pay these retirement obligations. And there's an added thing here, I'm not sure if it's in the presentation, is healthcare pensions, is retirement healthcare plans. Some companies still have these, and what it is a promise to pay lifetime healthcare for employees after they retire. So it's a really great benefit to have. We don't have it here at Seton Hall, but it's a really great benefit to have. Again, these older companies that have reputations for paying great benefits have had them, and once they started, they promised these things to employees. They can't eliminate it. The only way to eliminate it is to sell the obligation to someone else who will keep it funded, which can be very expensive. So what companies will do, and so if it's healthcare has gotten very, very expensive, and therefore the amounts of these liabilities are astronomical. And that means putting away a lot of money. So estimating the amount of a liability, the amount of money that you owe your employees for their pension plan, is a tremendously difficult thing to do. It's based on a lot of assumptions that are constantly changing. So companies set aside investments, and more often than not, those investments are much lower than the liability, and therefore these pensions are running in what's called an unfunded status. In other words, the assets are less than the liability, and eventually the company will catch up because the employees aren't retiring tomorrow. But in the meantime, the company might not have enough assets. My assets in this plan may be significantly under the liabilities. They could also be overfunded, by the way, when assets exceed the liabilities. So there are a lot of estimates to make in here, and the footnote disclosures are very difficult to understand. The thing is that if you do understand them, you may discover that a company has major problems, and that's why we need to go over this. So you need to understand what the PBO is, the projected benefit obligation. The projected benefit obligation is an estimate of the full liability to employees. In other words, how much money is the company going to have to pay its employees as they retire? Now, most of your employees aren't retiring for a while. So this is a present value calculation that involves, just like any other liability, that involves a number of variables that require assumptions and estimates. How many employees are actually going to make it all the way to retirement age? Some employees are going to quit. Some employees are going to get fired. How much money are they going to make at retirement? Because it's possible that the benefit they're entitled to is based on their salary at retirement. If their formula is based on years of service, what's the average, how many years of service are your employees going to work? And then if then how long are your employees going to live? Because you may have a lifetime benefit where they're entitled to a certain amount of money every year for the rest of their lives, and their spouses are entitled to 50% of that after they die. How long are they going to live, and how long are their spouses going to live? So these are very, very difficult assumptions. And that's why we have actuaries. Actuaries are going to use these assumptions and estimate a single liability number called the projected benefit obligation, the PBO. On the other side, again, this is the fund. So the fund is going to have a liability, the PBO, and it has assets. These are the investment assets. The company has invested cash into the pension plan, and the pension plan itself is going to invest this cash into stocks and bonds to earn a return. So as they need to pay employees, they'll sell some of the investments and pay the retirees. And in the meantime, they'll receive more cash from the company, what's called a contribution, and they'll invest that into more investments. So whenever the company pays benefits to retirees, your assets will go down, obviously, because cash is going out, and your PBO will go down because now you owe your retirees less money. So it's this combination of pension plan assets versus projected benefit obligation that's really going to be key to understanding what's going on. What the company is going to report is what's called pension expense. And pension expense is a whole formula based on a number of different things that have affected the pension plan. So it may be new benefits that employees have earned over the year. And it may also be reductions it may increase by changes in your formula. So this pension expense is going to be dictated. There's actually 6 different components of it. If you took financial reporting, then I'm sure you've memorized what they are. But basically, as the liability increases, because it is a present value, so as you have interest on that liability, that's a key component of pension expense, because you have a liability on your balance sheet and it's going to increase. So pension increase will increase as that liability increases. Now, it's also possible as you invest money in your plan that those investments earn returns. The better those returns, the less your expense. And that's kind of an indirect thing, the way that it works. That's for you to learn in financial reporting or intermediate accounting too. So what do companies invest in? They invest in stocks and bonds. And so you would have your beginning, the roll forward would be your beginning balance of pension plan investments plus their returns plus new contributions minus benefits paid to the retirees would be equal to your pension plan assets. The liability will increase by something called the service cost. This is your employees working. And the more your employees work, the more pensions they're entitled to, right? If I work another year, the formula says every year I work, I'm entitled to a little more money. So service cost is the increase in the pension benefit obligation, the liability, because employees are earning more pension benefits. Interest cost, PBO, is computed at present value. So every year it's going to accrue interest, and that's going to be interest costs. You have what are called actuarial gains and losses. You're making assumptions here based on how long you think people are going to live, when people are going to retire, and all sorts of other things like that. And so changes in these assumptions are going to be called actuarial gains and losses. And then you have benefits paid to retirees. As we said, as you pay off your retirees, your pension plan liability goes off. Now, what's really key here is to understand the funded status. And if your pension is fully funded, you're in great shape. But if it's underfunded, you may have a very serious problem. And the formula for this would be pension plan assets valued at market minus the PBO, pension benefit obligation. And this funded status is really key to understanding your company's situation. If this number is negative, then your company may have a serious problem. Where are they going to get all the money in order to fund their pension plan? And an underfunded pension plan, by the way, a company may literally need to close and liquidate its assets, is a liability like any other. So pension expense has 4 components. There's actually a 5th one, but it's not here, so let's ignore it. What's called the service cost. This is employees earning more benefits. Interest cost. This is the present value of the PBO, increasing in value over time, accruing interest. An expected return on plan assets. It's not the actual. What's interesting about this is that when companies record their pension expense, they don't record the actual return on plan assets, but rather the expected return. And this is going to reduce your pension expense. So the greater the expected return on your pension assets, that's income, right? The less pension expense you have. And you're going to use an expected number because the actual number fluctuates widely. And you're invested in stocks. So stocks may go up one year, they may go down, they go in all different directions, and it would wreak havoc on the balance sheet. So what companies do instead is they use the expected return on pension assets. And again, this is going to be a reduction in pension expense unless it's a loss. If it's a loss, then it's going to be an increase. An amortization of deferred amounts, and this is the difference between the expected and actual, will be deferred over the remaining expected lives of your participants, actual gains and losses, and these are usually spread out over a long period of time, and they're tucked into other comprehensive income. Now, if the deferred amount exceeds a certain amount, it gets too high, then it does have to go into expense on the income statement. And this amortization of deferred amounts can increase or decrease pension expense. Now, items 3 and 4 are actually kind of misleading because we all know that it's the actual returns that count. And we also know that amortization of deferred amounts, it sounds fancy, but the reality is that this is just an adjustment to keep the accounting very smooth. So items 3 and 4, we really don't want the expected return on pension assets here. We want the actual return. And this amortization of deferred amounts, we should really take deferred amounts in the period when they happen, arguably. So what are these amortization of deferred amounts? One is a change in actuarial assumptions. As we said, companies have to make a lot of assumptions when they're estimating their PBO. How long are employees going to live? When are they going to retire? How many employees are going to work until retirement or terminate early? All sorts of estimates like that. Those are the basic ones. So if you change any of these assumptions, let's say that all of a sudden people start living longer, which happens, so that would affect your PBO liability. And what companies are going to do is they could record a gain. In this case, if you estimate that you suddenly decide that your employees are going to live longer, that would create a deferred loss because that increases your liability. So to increase your liability is going to be a loss. And rather than record it immediately, what you're allowed to do is you're allowed to amortize them over the remaining working lives of the employees. And the difference, any deferred amounts, because the difference between the expense and the liability obviously needs to go someplace, is going to go to accumulated OCI, accumulated other comprehensive income on the balance sheet. Now you also have the unexpected returns. Remember that we put expected returns into the income statement. Unexpected returns, that is the difference between expected and actual, also are deferred and amortized over the remaining working lives of the employees. So those also are adjusted to accumulated OCI. So accumulated OCI goes into all different directions here. And what you can simply do is you can look and see what the balance of accumulated OCI is and either pin it to plan assets or to plan liabilities to see what should be going on your balance sheet. So expected returns is going to smooth your pension expense, and it's going to keep your earnings nice and smooth. A handful of companies do use actual returns, but these are in the minority, but they can have a big effect on the company's information. So here you can see what happens to AT&T's income statement. In 3 years they had losses. 1 year they had a big gain, another year a big loss, another year a gain, because whatever happens to the market is going to impact now AT&T's financial statements. Using expected returns will smooth out the income statement, and therefore it will smooth out pension expense and keep the income statement nice and steady and predictable. If the company uses actual returns, that's going to wreak havoc on pension expense, which could in turn wreak havoc on the income statement. So pension plan assets don't even belong to the company, they belong to the retirees. But if the return on those assets is too low, the company has to make up the difference. And if the return on those assets is unexpectedly high, then the company can make lower contributions. So fluctuations in the value of those assets is going to impact the parent company that sponsors the pension plan. So if your pension plan is overfunded, then you're going to have less pension expense, and that's going to increase your income. If your plan is underfunded, you're going to have more pension expense, and you're really going to have to you're going to need to know how the company plans to fund that pension plan. And here you can see the funded status. You can see that GE was funded for many years. GE is a big old company, so they have a defined benefit plan. And you can see that they were funded for many years, but then they become unfunded starting in 2008. And so what happened was, as they became unfunded, and perhaps their pension assets had an unexpectedly low return, that meant the company had to pitch more money into the pension, and therefore pension costs went up. So if you have a fully funded pension, then pension costs will be lower than if you have an unfunded pension and you need to make more payments. The key to all of this is the footnotes, and you got to look at the footnotes very carefully. This is FedEx, and FedEx again is a legacy company that has a defined benefit pension plan. And these footnotes honestly are very off-putting to people who aren't accountants, but they're extremely important. So here you can see that their funded status is negative, and specifically for 2015, their PBO is $27,512 million, while their plan assets are only $23,505 at the end of the year. And for each of these, you can see a roll forward. So you can see the beginning of the PBO at the beginning of the year of 2015, plus or minus all these items we've been talking about, and then the figure at the end of the year, and then the value of the plan assets plus return on plan assets and contributions from the company, minus benefits paid equals the end of year balance for the assets. So if you have $27.5 billion in liabilities and only $23.5 billion in assets, that means you're $4 billion underfunded. And looking at that compared to 2014, you can see that it's a big increase in the unfunded status. In 2014, they were only unfunded by $2.67 billion, and now they're all the way up to $4 billion. So somehow the company is going to need to fill in that gap, and that's a major challenge for the company. This is why pension accounting is so important to understand. You can't really look at FedEx without understanding what's going on with their pension. Now, as they become unfunded, their pension cost is increasing. And the key component of this, you can see that they have expected return on plan assets is nice and smooth, but they had some kind of actuarial loss in 2015. And they must have changed an assumption, or maybe they made the plan a little bit more generous and they decided to take it in the whole year. So that forced them to increase their pension cost. Now, when you're looking at the company's operations, you might want to ignore this, or you might want to include it as an operating expense. But whatever it is, you need to understand that you have a major expense category going from $1.1 billion gain in 2013 to $109 million relatively minuscule expense in 2014, all the way to $2 billion loss in 2015. So if you were analyzing FedEx's income statement, you would want to understand what this item is and understand what this item is, and also think about whether or not it really belongs in the income statement or not. Because this is outside the company's operations in a way, but paying your employees is part of the operations. So their actual return for 2015 was 17.18, exceeding the expected return of 16.78 shown here, so it's slightly higher. And therefore, the $40 million additional return would reduce your periodic benefit cost by a relatively low amount. So we want to understand future cash flows. And when you see something like this, it tells you that the company is going to need to come up with a lot of money sometime in the future in order to cover this unfunded status. Because the company needs to pay for this. And by the way, payments for pensions are operating cash flows. It's part of paying your employees. Here you can see the estimated benefit payments, and companies need to disclose the expected payments in the future. This is how they plan to cover that $4 billion unfunded status. So, and these are the individual payments. Now, if your investment returns go down, then the amounts of money they're going to have to pay in the future is obviously going to go up. A lot of assumptions go into this, and companies need to disclose many of these assumptions. And here we can begin to see why the company had such a large loss in 2015. The discount rate they're using is decreasing to determine the benefit obligation is decreasing from 479 to 460 to 442. And this would be based on historical experience. Historically, the discount rate was lower, so therefore they need to lower it. That would increase the liability and therefore increase the pension expense. That would increase the liability. The discount rate used to determine the net periodic benefit cost has also gone down. And the rate of increase in future compensation levels, that estimate has gone up. And the rate of increase in future compensation levels, whether it's used to determine the benefit obligation or the benefit cost, has gone up. And the expected long-term rate of return on assets, which is used to estimate the expected return on assets, a component of pension expense, went down in 2014, but it stayed steady in 2015. So companies are constantly changing these estimates, and these affect the overall amount of PBO. And they may also affect other comprehensive income. So an increase in discount rate could affect a pension expense in either way. An increase in investment return is going to decrease your pension expense, and an increase in wage inflation is going to increase your pension expense. So what we want to do is we want to understand, especially if a company is in an unfunded status, where's the money going to come from? The company is going to need to come up with money to pay for this, and this can have a profound effect on its financing activities, its investments, and its operations. The company may need to sell divisions, and this is not uncommon, in order to fund its pension plan. And you've even had companies that were forced into bankruptcy, including General Motors and Chrysler, that were forced into bankruptcy because their unfunded pensions were too high. So, as I said before, everything depends on how well these pension plan assets return. And if the returns are good, then there may be enough money for the PBO. But if the returns are too low, or they can't keep up with the PBO, and you have an unfunded status in your pension, then companies have to make up that shortfall. And the money's got to come from someplace. And what happened to General Motors and Chrysler, it also sort of happened to Ford, but Ford managed to squeak through it. What happened to General Motors and Chrysler was this came at the worst possible time. So their pension plans were way, way ridiculously unfunded. And at the same time, the price of gas increased. And the price of gas increased so high that people couldn't afford the large cars that General Motors and Chrysler were making. At the time, they had almost given up on small cars altogether. And so all of a sudden, the big SUVs and the big cars that GM and Chrysler specialized in were no longer interesting to customers. So their sales crashed, and they were no longer able to continue making the needed contributions to their pension plan. And that forced both companies into bankruptcy. So there are many, many assumptions that go into pensions. Expected return on pension investments, expected rate of wage inflation, the discount rates used to compute the PBO, and mortality rates, how long you expect your employees to live. And these are going to impact pension expense, which in turn is going to impact profit. So a profit that's due to an increase in expected change in the assumptions is not as good as a profit that's due to an increase in sales. And that's the thing to be aware of here. Now, what do we do with this little scheme of operating versus non-operating? So service cost is the primary component of pension expense most of the time. What you would really want to do is you want to break pension expense into its components and record service cost as an operating, and probably everything else as non-operating. It's arguable whether gains or losses on deferrals and things like that. But the service cost is usually the biggest item, and interest cost is second largest. Service should be operating. Interest cost should be non-operating. And this is probably the best way to account for this. If you're wondering what to do about restaurants, I don't think there's any restaurants that have defined benefit plans at all. I don't think anybody working at McDonald's is making has a defined benefit pension plan. All these, minimum wage employees. So operating versus non-operating. On the balance sheet, the pension obligation is for compensation, so therefore it's operating. Some may argue that because this is at present value, it could be treated as non-operating. But the authors of the book, and I think this makes a lot of sense, say you should treat the liability as operating. There's one more type of pension which you should be aware of, and this is called OPEB, other post-employment benefits. And this would be situations where companies offer to pay retirement benefits besides cash to their employees. And 99% of the time it's health insurance. Sometimes it could be life insurance, I think, other kinds of insurance, but it's primarily health insurance. I don't think they do life insurance, probably they outsource. Everybody outsources that. So companies, um, these oftentimes are not handled by a PBGC, Pension Benefit Guaranty Corporation, and so companies are usually not required to fund them. However, they have to pay them. So companies still need to record a PBO for other post-employment benefits. They may choose to fund it, most choose not to fund it, and this is a liability and it needs to go on the balance sheet.